Hi, good evening, everyone. Good evening. Good evening. Join fast. Welcome to the first lecture of Forex, BFM Forex. Okay. Hi, everyone. Join fast. I'll start within 1 minute. Everyone. Yes. Hi. Good evening. Good morning, yeah. I generally take the classes in the evening. Good morning, everyone. Chalo. Let's start. See, our first lecture is Forex business. Okay. We are in the revision batch, so we'll be doing it a bit fast. Okay, I'll be sharing you these notes also. Kindly note, these notes are comprehensive, total 141 pages. Okay, for BFM, total 141 pages. You can read complete 141 pages for notes. I'll be sharing you 2 3 more PDFs. Okay, one is for the master PDF, important definitions are given. Then one PDF I'll be sharing for the numericals for module A, B, C, D separately. So I'll be sharing with you all the PDFs, not today, from tomorrow. Okay. So kindly go through the PDFs also. Also follow the classes. So first one, foreign exchange and forex business. See this. Basically, foreign exchange, foreign currency, it includes all the currencies, deposit, credits, balances payable in the foreign currency, right? It also includes draft, LCs, bill of exchange. What do you mean by this? See this currency, deposit, credits. Credits where? Credits in the Nostro accounts. Okay? What is a Nostro account? Nostro means my account with you. Okay? There is also called as no Vostro account, your account with me. So it includes currency, deposits, credits, balances payable in foreign currency. It includes everything. Kindly note this. Huh? It also includes draft TCs, LCs, bill of exchanges payable in foreign currency. Okay, claims payable abroad. Whatever is claim payable abroad will be included in foreign exchange. Whatever is payable abroad. Foreign currency is a narrow term which includes hard currency. Now look at this foreign exchange and foreign currency. Understand the difference. Top part was foreign exchange. Second para is foreign currency. So narrow term which includes hard currencies, whatever cash you are having. Forex market. Now this question comes sometimes. In how many seconds does it change? It changes every 4 seconds. Okay. It is applicable from Monday to Friday. Okay. Now Monday to Friday it is said, but it's actually working throughout the 24 hours. Means 24/7 it is working. Okay, because whenever you have Friday over here, you have some other day on in some other country, right? So it changes every 4 seconds and it's available 24/7. What is TOD or cash rate? See this cash rate, TOD or cash ready, we call it. Whenever the settlement is done on the same day. Okay. Tom. Tom means whenever the settlement is done on the next working day. Spot. Spot means whenever the settlement is done on the second working day. Now, what do you mean by second? Next to next. Okay. 48 hours. Forward rate. After few days or after for a few months means after the spot, whichever date is there, that's called as forward. Kindly note. Okay. After the spot, whichever date is there, that's called as forward. This you have already studied in your JIB also. Okay. Now the problem over here is, see this, the next day or the second day is a holiday in either of the two countries. The settlement will take place on the next day. Next day means next to next day. Means whenever there is a holiday, the next day of that holiday is taken. Okay. There are two types of rates, fixed and floating. What is the fixed rate? What is the floating rate? Fixed rates are determined by the market forces. Floating rates are determined by the market forces of demand and supply. Now, like in our country, Bharat, we have floating rates. Okay, we don't have fixed rates. The dollar rate fluctuates. Everyone, kindly note. Okay, card rates means what? Card rates are calculated at the beginning of each day based on the current market rate. So, card rates means whatever rates we have in our banks, which are given by our treasury. That these are called as card rates. So, these are always available at the beginning of the day. In the morning, they should be available. Otherwise, how will you tell the customer the rates? What are the factors affecting foreign exchange rates? Okay. So fundamental factors, balance of payment. Now, balance of payment means there are two balances. One is balance of trade. Second is balance of payment. Okay. So balance of trade includes your export import. Okay. All the export import. Balance of payment includes balance of payment. It includes your other than export import. Okay, means NRI sending the funds, or FDI, FPI, or ECB. All these are under balance of payment. GDP rates means if the GDP rates are higher, then the currency becomes stronger. Fiscal and monetary policy. Now this is for the fiscal and monetary policy. This is fiscal policy is given by the central government, finance ministry. Monetary policy is given by the government, by the RBI. Okay. So fiscal and monetary policy both are responsible. Fundamental reasons. Interest rates. Okay. Interest rates means the difference in the interest rates. In short run, high interest rate attracts overseas capital and local currency appreciates. If you increase the interest rate, okay, if you increase means who will increase? RBI will increase. If RBI increases the interest rate means repo rate we are talking of. If RBI increases the repo rate, then what will happen? Everyone will try to invest with you. There will be more FDI, there will be more FPI. So that will appreciate your currency. Local currency will appreciate. Political issues means stability, right? Now this you know already. Surplus of foreign currency makes local currency stronger. Obviously, now we are having, look at this this forex reserve we are having huge now. We are having around 700 billion foreign exchange dollars. So that's why our currency has become stronger now. If you see, our rupee will appreciate now. In coming 5 to 7 years, you'll see the rupee growing much stronger. The dollar rate will come down from 83 rupees to almost 10-20 rupees. It will be so low. Okay, because rupee is getting stronger now. Whenever rupee gets stronger, the rate reduces. Okay. Next one. Now, what are the technical reasons? Technical are always short term. Kindly note, fundamental reasons are long term. Technical reasons are always short term. Okay. So, technical reason means middlemen, speculation. The speculators who are the middlemen over there, brokers. Okay. They will always speculate and bring the rate higher or lower. Same thing happens in stock market also. Okay. Freedom on capital movement brings FDI and local currency becomes stronger. Freedom in capital movement means if your laws are such that, if your rules and regulations are such that the money can flow in and out of the country very fast. So in that case, what happens? In that case, there will be more movement in the capital. More funds will flow into your country. Now, same thing is happening in our country also. We have made the laws very regarding forex. We have made the laws very secular or very easy. Okay, buy and sell. Kindly note, buy low, sell high maxim. Always remember this. Buy low, sell high means whenever you do any transaction, you have to buy at a lower rate and sell at a higher rate. Kindly note this. This is a general business rule which is used and it is used in Forex also. Kindly note, buy low, sell high is used when? Buy low, sell high is used only when, kindly note, only when we don't know the exact rates. We don't know the exact rates, okay? Exact rates means, suppose if I tell you what is the rate on 14th of October, you don't know. So in that case, what will you do? You will take one rate lower, one rate higher, beginning of the month, end of the month, and then decide buy low, sell high. I'll show you when we do the Forex numericals. Okay. Next. So buy low, sell high. Kindly note. Buy rate is the bid rate and sell rate is the offer rate. So buy is also called as bid, sell is also called as offer, or it is called as ask also. Ask. Offer or ask. Both are one and the same. Okay. Now when the local currency is fixed, bank will have to have more foreign currency while buying and give less foreign currency while selling. So buy low, sell high means that. Here, buy low, sell high means basic logic, remember. You have to buy at a lower rate and sell at a higher rate. Now it can be in any ways. It can be in direct quote or it can be in indirect quote. Okay. Now what are direct and indirect then? Direct means what? Direct quote means your foreign currency is fixed or dollar is fixed. Okay. So 1 USD equals to INR, let's say $55. Example. So INR is fluctuating. What is constant? Dollar is constant. Okay. Are you all getting this? Everyone? Are you all on the same page? Am I going too fast? Everyone? Am I going too fast? Or no? It's okay now? This speed? Because we have to complete the portion also. Type yes in the comment section. Are we going too fast? Everyone? Are you with me? Yes, na? Acha. Okay. Because we have to complete the portion also. That's also important, isn't it? So, direct and indirect trades. Whenever see this, whenever your foreign currency is fixed, means dollar is fixed. $1 equals to 55 rupees. So who is changing now? Rupee is changing. So that is called as fluctuating. Dollar is fixed. And indirect rates, it's reverse. Local currency is fixed. Means 1 rupee equals to how many dollars? Say this. Okay, here rupee is fixed and dollar is fluctuating. Okay. At present, following four currencies are quoted in indirect mode. Which are the four currencies? Euro, GBP, Australian dollars, and New Zealand dollars. Okay. So these four currencies are quoted in this indirect mode. Okay. Euro, GBP, Australian dollars, and New Zealand dollars. Got it? Now understand the difference between forward transactions. Now look at this. There are two types of transactions. One is spot and second is forward. Spot and forward. Spot means what? Here, we have just now seen cash ready, Tom, then spot, and then forward. Okay. So cash ready and Tom, they are generally not used. Generally, the whole world market follows spot and forward. Two rates are followed, spot and forward. Okay. Whenever you want to do the transaction immediately, always use the spot rate. Spot rate T plus 2. Okay. Whenever you want to do the transaction in future, then you will be using the forward rate. For forward rate, we call it bill rate. Forward rate is also called as bill rate. Okay. Clear? TT rate, spot rate is also called as TT rate. Kindly note, spot rate is also called as TT rate. Forward rate is also called as bill rate. So whenever you hear the word bill rate, kindly understand we are talking of forward. Whenever you hear the word spot, kindly understand we are talking of TT. Okay. So buy or what are the forward transactions? Kindly note. Now spot is here. Firstly, understand spot is very easy. Suppose if I say $1 equals to 55.80. So what does it mean? It means 55.80. It's always given like this. See this. It's like always given this way. 1.3810, 1.38, 1.3180, 1.3190. So this side is always buy, this side is always sell. Kindly note this. 3180 is buy, 3190 is always sell. Okay? Buy, sell, buy, sell. Kindly note this. Left is buy, right is sell. So whenever you do any transaction on TT basis or spot basis, you use either buy rate or sell rate. Now, which one will you use? Which rate will you use? Kindly note. Whenever you are doing exports, everyone take pen and paper in your hand. Okay? Write down whatever I am saying. Very important one. Whenever you are doing exports, okay, you always use the buy rate. Exports means buy rate. Whenever you do the imports, you always use the sell rate. Okay? So now I'll ask you, suppose if I want to export, let's say this same currency, see this 1 euro equals to USD 1.3180, 1.3190. Suppose if I want to do an export, okay, so which rate will I use? 1.3180 or 3190? If I am doing an export in euro, then which rate will I use? 1.3180 or 90? What do you say? Which rate should I use? 1.3180 or 90? 80. Very good. You will be using 1.3180 because you are doing the buy rate. Okay. Export. Now let's come to this forward rates. Forward means what? Always remember spot rate means TT rate. Spot rate plus premium or spot rate minus discount. Now whatever it is. Now what do you mean by this? Premium and discount. Kindly note. Look at this. Again look at this example below. 1518. So now look at this one important point. You will always get the premium or discount in the forward rates. You will never get the premium or discount in the spot rate. Okay? Premium or discount is always received at the forward rates, not at the spot rates. Keep this in mind throughout your life. Suppose if I ask you over here, look at this. 1 euro equals to 1.3180, 3190. If I ask you what this currency is in premium or discount, see this right side is bigger. When your right side is bigger, you always call the currencies in premium. When your left side is bigger, suppose if this would have been 49.41, left side is bigger, buy is bigger, then you always call the currency at discount. Okay. So now my question to you is, this is the spot rate given. Euro 1 equals to USD 1.3180, 3190. Now you tell me this currency is in premium or discount based on the spot rate only. Based on the spot rate, tell me whether the currency is in premium or discount. 1.3180, 1.3190. What did I say? Right side is bigger, it is premium. Left side is bigger, it is discount. So now what is bigger? 3190. So the currency is in premium or discount over here. You can tell me. Here it's like this. Kindly note everyone. Yeah, correct. Kameshwari Guntur. Premium you have given the answer. Here, everyone kindly note. You can never get the rate as premium or discount on the spot rate. You can never get it on the spot rate. Kindly note. You can always decide whether the currency is in premium based on the forward only. So when I say 1 euro equals to 3180, 3190, I can never say this currency is in premium or discount. I can only tell you whenever I see the forward rates. So if you see the forward rates now you can tell me. From here you can understand that right side is bigger, left side is smaller. So that's why whenever you have this right bigger, left smaller in forward market, then you can say the currency is in premium. Premium means what? You'll have to add it. Okay. So now if I ask you, see this. If I want to do the export buy, I want to do the export buy. So in this case, if I ask you now, what is the forward rate after 1 month? What is the forward rate after 1 month? If I ask you, then what will be the forward rate after 1 month? So it is USD 1.3180 plus 0.15 plus, kindly note, it is plus 0.15. Okay. If I ask you the forward rates for 1 month, okay, so 1.3180 plus 0.15. Okay. Suppose if I ask you, I want to get the sell rate after 2 months. Now give me the sell rate after 2 months, everyone. Give me the sell rate after 2 months. Give me the sell rate after 2 months in this. Fast, fast, fast. Give me the sell rate after 2 months, everyone. Sell rate after 2 months. Huh? I want the sell rate after 2 months. Give me fast. So it is 1.31 sell rate. Sell rate. Everyone, answer 1.3190 plus 0.37. 1.3190 plus 0.37. Everyone, are you getting this? Here, sell rate after 2 months, 1.3190. See this, spot rate plus premium. Now I want the premium for 2 months. So 1.3190 plus 0.37. 0.37 why? Because 2 months premium is 0.37. Okay. So 1.3190 plus 0.37. So it will be what? 1.6890. Okay. Now you give me the buying rate after 3 months. Give me the buying rate after 3 months. Everyone. Give me the buying rate after 3 months. All of you. Give me the buying rate after 3 months. 3 months is 1.3180 plus 0.41. Okay, 0.41. Yeah, it's like this. Even I used to take the same Purnima earlier. 0.0037. I used to take it. But the problem is I've seen in your books. In your books, they have taken directly from point. I'll show you that numerical also. Hold on. In your books, your CIB books, they have taken directly. Means they use this. Let me show you. Exchange rate. Whenever we'll solve the numerical, I'll show you that numerical. That numericals are taken directly. They take after the point your calculations in the books. They take the first one only directly. Okay. So that's why even I used to take the same one earlier. 0.00 like that. But after looking at your CIB books, I've changed this For at least for CIB, I've changed it. Okay. Actually, we take it that way only. Yeah. No, correct way is actually in your CIB market, kindly know, or in your basically CIB, you are given the rates only up to point 2 points. There you are not given the rates after means up to 4 points. Generally, up to 2 points you are given. Okay, which if you ask me the exact correct way, the correct way is 0037. This is the correct way. Okay. The actual correct way is 0.0037, but your CIB books say 0.37 directly. So that's why in exam, kindly follow the books. Okay, yeah, follow the books. And in your exam, I think so because I have seen up till now, they don't ask you after the point. They don't ask you 4 digits. They ask you only two digits. Okay, chalo, we'll see the numericals now. At that time, I'll show you. Yeah, see this. Here I used to take 0.00449. But then what happens? It depends on your books now. So next now. Now look at this. Uh, this already we have done. Yeah, the same. Now look at this example. This example is regarding the discount. Okay. See this. The euro 1 equals to USD 1.318090. And forward differentials are given as 2419. Now look at this. This is the discount part. Okay, discount. So discount means what? You'll have to subtract it. Why discount? Because right side is smaller, left side is bigger. Right side is smaller, left side is bigger. So it is discount. So what will you take? Suppose if I ask you 2 month. So 2 month it will be what? One buying if I ask you 1.3180 minus 26 means now as you said it is 0.0026, but depending on your answer in the book, okay, or in the exam, you check what is the correct one. Okay, actually it is this way only, but in your books in some numericals they have taken directly 0.26. I'll show you that one or two numericals later. Okay, so this is the discount part. Similarly for a second month, now you can take these examples. That's easy one. Exchange margin is deducted while buying and added while selling. Now this is about exchange margin. Now look at this. There are always two margins or two rates. In any forex problem, you have to focus on 3 points. Okay, you'll always have to focus on 3 points. Which are the 3 points? Number one, whether you have to take buy or sell. First one, very important one, whether you have to take buy or sell. Second important, forward rates, whether forward rates are asked, and if they are asked, then whether it's premium or discount, that is forward rate. And third one is exchange margin. For any buying transaction, you'll have to subtract the margin. For any selling transaction, you'll always have to add the margin. Okay? For buying, you'll have to subtract. Selling, you'll have to add. So how do you remember this? See, the spelling of sale is what? The spelling of sale. S-A-L-E sale, right? S-A-L-E sale. So in that case, what you do? Remember this. S and then A. So A is always attached to S. So that's how you will be remembering. Selling is always adding for exchange margin. Otherwise, it will be very difficult for you to remember. Okay. Next is cross currency rates. Now cross currency rates are applied whenever you don't have the direct rates. Direct rates means $1 equals to 80 rupees. If you don't have it, in that case, what will you do? You will take help of some other currency. Means, for example, generally dollar is considered as a stable currency. So suppose if I want to get the rates of GBP against INR, GBP against INR, in that case, what do I do? GBP to INR. Suppose if I don't have GBP INR rate, but dollar is constant. So what do I do? I take GBP to USD and USD to INR. Okay, GBP to USD and USD to INR. So what does it mean? These rates are given to you. See this, 1 USD equals to this many rupees. 1 GBP equals to this many USD. So what do I do? GBP to USD into USD to INR. I'll multiply this. This is called as cross rate. So I'll multiply this 48.1 into 1.6. So you'll get this as 76.96. Okay. So this is the way you'll have to do for cross currency. Okay. Kindly note. Now, one more point which I would like to show you, that for JPY, okay, that JPY I'll show you in the numericals. For JPY, you have to do a bit reverse thing, that I'll show you in the numericals. Okay. So an import bill is to be retired. So rates applied are what? So import bill. Okay. Import bill means in import, what will you do? Will you do the buy or sell? Just now I told you. In import bill, what will you do? Buy or sell? Import. In import, what will you do? Buy or sell? Everyone. Whenever you are doing the import transaction, what will you do? Buy or sell? Correct. Very good. Raju, you are right. Rupali, correct. Sell. Okay. So you will be doing sell. So if you are doing sell in import, so what will you do again? See here, we are talking of cross rates over here. So these are the two rates given to you. GBP equals to 1.597585. USD equals to 48.1415. And TT margin is given as 20%. So now, what will you do in this case? Suppose if I have to do the import of, let's say, how many GBP? 1 lakh GBP. Okay. So in that case, what rates will you apply? Okay, everyone try this now. What rates will you apply? 1.597585, 48.1415. So let's try this. How will you solve this in this problem? Try it yourself. I'll also show you how to solve this. Chain rule. Very good. Chain rule. That is how you will be solving it. Okay. So now let's solve this. Take this one. For what was the first thing given? I'll just give you the rates now. 1 GBP was given as GBP. Okay. 1 GBP equals to, what was it given? 1.597585. So 1.597585. Okay, dollar. And $1 was given as, let's take 78.1415. 78.1415. And TT margin is given as 0.2%. TT equals to 0.20%. Now you have to do the import of import. Okay, import of GBP. GBP. What? 1 lakh. 1 lakh. Okay. Now let's do this. So in this case, what will you do? GBP 1 lakh is given. So do you have the rate for what we require? GBP to INR we require. GBP to rupees we require. But we don't have the rate right now. So what will you do? GBP to dollar into dollar to rupees. So this you are having it. So GBP is what? Import. Import means selling. So 1.5985 into dollar to rupee is what? 78.15. Kindly note. You have to take the import means selling. Okay. So whatever rate you get. So what is the rate? Answer for this? 1.5985. Okay. Minus into 78.15. So get the rate now. What is the answer? So it is 124.92. So 124.92. Okay. 124.92. But is this your final answer? No. Why? Because what did I tell you? In any forex problem, you have to first focus on number one, buy or sell. Number two, forward points. And number three, TT margin or exchange margin, TT. So this we have done. We have taken sell. This we have taken done. No forward rate is given, so zero. This is zero. Now TT margin is remaining. What is TT margin given? TT margin is given as 0.2%. So what will you do? 124.92 into 0.2%. 0.2 upon 100. Okay. So what will you get now? Kindly note, this is to be multiplied with TT margin, whatever is given. Okay. So it is 124.92 into 0.002. Zero point 0.2 upon 100. So 0.002. So it is 0.249. So 0 point, you can take two digits also, 2498. You can take two also, no problem in this. Now what will you do in this case? Now will you add or subtract this TT margin? This is my TT margin, TT or exchange margin. Will you add or subtract in this case? You are doing import. Import means selling. For selling, what do we do? In TT margin, for selling we add. So it will be, your answer will be 124.92 plus you can take only 0.24. So it will be the 124.92 plus 0.24. So it is 125.16. So your final rate will be 125.16. This will be your final rate. Got it? This is how you will be doing the numerical. This is your final rate. Got it? Next one. So got this? One sec. Yeah, this we have done. Sure. In India, there is full convertibility of current account transactions. What do you mean by this? Kindly note current account transactions. Current account transactions means we are talking of balance of trade. In balance of trade, there is full account convertibility, full rupee convertibility. Okay? Full rupee means, here, understand the difference between balance of trade and balance of payment. In balance of trade, you do import export. In balance of payment, you don't do import export. You do whatever you NRI send you, whatever FDI you get, whatever FPI you get, but no business. ECB, external commercial borrowing, all these are under balance of payment. Balance of trade, only one thing, import export. So rupee is fully convertible in balance of trade. Rupee is partially convertible in balance of payment. What do you mean by this? Under partially convertible, you have to ask RBI while doing some bigger transaction. Above that 2,50,000 LRS. LRS liberalized remittance scheme is brought by RBI. How much can you transfer under LRS? How much can you transfer under LRS? Everyone. In LRS, how much do you transfer? What is the amount you can transfer under LRS? USD? What is the amount you can transfer under LRS? USD? How much USD can you transfer? Yes. 2,50,000. Very good. Okay. 2,50,000. Okay. 2,50,000 you can transfer. Okay. So that's why we call it, it's partially convertible. Means suppose if I want to do the transaction of 3 lakh dollars. Suppose tomorrow if I have a transaction of 3 lakh dollars. So I won't be able to do it. I'll have to ask RBI. That's why we call it partially convertible. You'll have to ask RBI whenever you want to do a big transaction. But in balance of trade, I can do any amount. Suppose if I get an order from USA tomorrow for 10 lakh dollars, so I can take it. No problem. Nobody can ask me. Okay? Or nobody will question me. So that's called as convertibility. Okay? Now only Japanese yen, yes. This Japanese yen I'll show you in the numericals also. Japanese yen is always a problem while solving the numericals. Kindly note. Okay? A wants to remit JPY 100 million at TT spot with a margin of 0.15%. Given USD INR rate is this much, 48.2526. Japanese USD to JPY rate is 90.5060. So you have to get the rates now. No, Japanese yen is always a problem. Why? Because look at this. What do we require here? We will be using the chain rule over here. Chain rule. For using the chain rule, what do you require? You require JPY to INR. That's what you will be requiring. JPY to INR. But do you have JPY to INR? No. So what will you require? JPY to USD into USD to INR. That's what you will be requiring. JPY to USD. Everyone note this problem. Okay, because Japanese yen is always a big issue. Okay, let me show you. See this. A wants to remit JPY 100 million at TT spot with a margin of 0.15%. Given USD INR rate is this much and JPY rate is this much. Now what do you require? You require JPY to INR. That's what you are requiring. But do you have it? No. What do you have? JPY. You require JPY to dollar. Dollar is below over here. Into dollar to rupees. This is what you will be requiring. So do you have these rates? See this. USD to INR. You have it. You want to remit. Remit means send. Remit means send. So it is going outside. Funds are going outside. So it is buy or sell. You tell me. You want to remit. So it is buy or sell. Who can tell me? You want to remit the transaction. Remit the dollars. So is it buy or is it sell? Tell me everyone. Is it buy or no? It is sell. It is sell because you want to remit. Remit means sending out. Here, kindly note. Keep the very basic in your mind. Kindly see this. Whenever, here, why do I say import means sell? Here, import, sell, remit. It's one and the same. Everything is same. Because in all of them, dollars are going out. This is Bharat. and this is other country. So dollars are going out, sell, remit, and vice versa. Export, buy, or funds coming in. So it is dollars are coming in. Kindly note this. Okay. So whenever you get any of these, kindly note you have to take the right side, this side. Okay. You don't have to take this side. You have to take this side. Number one. Number two, whenever you are getting this import or the, sale transaction, kindly note your TT margin will always be plus. TT will always be plus, right? Because TT margin is what? Always plus. Got it? So now what will we do over here? See the same problem. So JPY to dollar, that's I don't have. I am having dollar to JPY. That's why I said this is always a problem. So what will you have to do? See this USD to dollar to JPY you have it, and you are doing the sell transaction. So you will be using this. Kindly note now. I'll be using 1 upon 90.60. I'll be using 1 upon. Why 1 upon? Because I want JPY to dollar. And what am I having? I'm having dollar to JPY. See this dollar to JPY I'm having. I want JPY to dollar. So I have to reverse this. So 90.60 into dollar to rupee. That's simpler. So 48.26. So now solve this. Whatever answer you get. What is the answer you will be getting? 48.26 divided by 90.6. So it is 0.53. Okay, 0.53. Okay. So this is my 0.53. So what will I do now in this case? Is this my final answer JPY to rupees? Everyone give me. Is this my final answer, or is something required more? Is this my final answer? Here, in any dollar transaction, what do we do? Buy or sell, forward rate, and TT margin. So buy or sell, what is this over here? Sell. So that is done. Correct, Rupali. Still something is remaining. What is remaining? TT margin is remaining. Right? Still TT margin. Buy or sell. Second is forward rate. So I want to do it on the TT rate. So forward is 0. So forward equals to done. So here, I'll just write this over here for your reference. First, buy or sell. Second, forward rate. And third, TT margin. Never forget this sequence. Okay. So this is sell. This is 0. No forward margin. Why? Because I have to do it on the spot rate. But TT margin, I have to take it. So 0.53, this is my rate into, so 0.53 into 0.15 upon 100. Upon 100. Why? Because 0.15%. So do it now. 0.53 into 0.0015. Okay, so it is very less. Okay, so 0.00079. Okay, so almost like nothing only. So what will you do with this? But you'll have to add this to this. You'll have to add. Why? Sell. You are doing the sell. So whenever you are doing the selling, you'll have to add this. So add this. So your answer will be 0.53 then 079 if it is asked. Otherwise only up to 2 points. Got it? So this is the way you'll be doing this. Whenever you have to do the JPY is always a problem. Kindly note, because you have to do the reverse thing over here in JPY. Okay? Chalo, next one. This already I have covered. TT, this let me cover. Following 4 types of buying and selling rates are important. Which are those? TT buying, bill buying, TT selling, bill selling. Now, what do you mean by this? Okay, TT buying, bill buying, TT selling, bill selling. Now, TT buying means, here, whenever you use this word TT you always use it for spot. Whenever you use the word bill, you always do it for the future rate. further. In India, we take up to 4 decimals, but in your exam, you get up to 2 decimals only generally. Okay. So TT buying, bill buying. It is required to calculate when the nostro account is already credited or being credited without delay. Now see here, without delay. Kindly note, anything without delay, which is done on the same day, it will be TT. Okay. Now this is buying because it is credited. Export, funds are coming in. Okay. Bill buying. This is required whenever you do the future dated transaction. Bill buying rate is applied when the bank gives INR to the customer before receipt of the foreign exchange in the nostro. Before receipt means what? Before receipt, it means what? So kindly note, you are using the bill rate whenever you are financing. Here, I have not received the funds in my nostro account. Means someone was to give me and then I have to give you. Here, understand the logic behind this. Let's say somebody is giving me the dollars, some buyer is giving me the dollars, and then I am giving the dollars to you. So your myself giving to you is step number 2. Somebody else giving me is step number 1. So in that case, what happens? Whenever the first party doesn't give me, that buyer has not given me, but I am giving you right now. So what am I doing actually? I am taking the risk. I am financing. So whenever you finance, in that case only you take the bill buying rate. Okay. Now similarly, reverse thing is true over here. TT selling and bill selling. TT selling means what? Any sale transaction where there is no delay. No delay means TT. Okay. Same. Now remaining thing is okay. See here, quoted at TT selling rate. Very important line. It is also desired in crystallization of export bills and cancelled forward purchase contracts. Kindly note, TT rate is used in crystallization and cancelled for cancellation of forward purchase contracts. So whenever you do the cancellation, you will always use the TT selling rate. Okay. Whenever you do the crystallization means what? Crystallization means converting the foreign exchange dollar this loan into INR loan by closing that loan. Generally, we use this crystallization whenever there is an NPA. Whenever there is a NPA, at that time we use it. Okay. So TT selling rate is always used for crystallization and cancellation of forward contracts. Bill selling rate is used when handling the documents is involved. So bill will be used whenever you are financing. You are taking the risk. You are taking the future dated transaction. So there you are taking the risk. So bill selling rate is applied when you involve the documents. Payment against the import transactions on future date. So whenever you use the bill rate, you will be using spot plus premium or spot minus discount. Okay. Chalo, we'll be stopping over here. Tomorrow we'll do the numericals. This numericals part we'll be doing it tomorrow. I'm having I'll directly take it from your books only. Okay. So we'll be doing this numericals tomorrow. This PDF I'll be sharing with you uh, tomorrow or day after tomorrow. I'll share it. Okay, this complete PDF is there. This is a complete BFM PDF. Okay, so this much is also quite enough for you. Chalo, bye everyone.